Good morning, everyone. Your Excellencies, ladies and gentlemen, welcome to this 13th edition of the AIM Summit here in Dubai. My name's Rachel. I have the absolute pleasure of being your MC over the next 2 days. I haven't MC'd an AIM Summit event since pre-COVID, so it's great to be back and see a lot of familiar faces in the audience, but also an awful amount of new ones. So credit to Raha and the team for really growing and scaling this event to standing room only. I know that the best introduction is a short introduction, and we're already running a number of minutes behind time. So just quickly from me, obviously need to thank our sponsors and everyone who helps to make this event happen. Our strategic partner, Dalma Capital, who we'll be hearing from soon. Our gold sponsors, Hive Technologies, the Family Office, Marathon, Merkle Standard, Binance, and CoinShares. All our silver sponsors and our hospitality sponsor, and associations, moderators, and our fabulous array of media partners. A quick note about the sort of structure over the next 2 days. Today we're going to be taking the broader macroeconomic view and also looking at alternative asset classes such as venture capital, private equity, and private debt. Tomorrow the focus is going to be more on digital assets and mental health, which seems to be quite a fitting duality of topics given everything that's going on in the markets. Later on today, we're going to be hearing from former US Treasury Secretary Larry Summers and a look at beyond the headlines. As someone who's trained as a journalist, I completely appreciate that there is always more to a story than just the headlines. But to give you a bit of macroeconomic perspective about what's been going on in the world just in the last 2 days, in case any of you were at the Grand Prix or the Golf or the World Cup and haven't had a chance to read the news, here's a little bit of context. $500 million FTX hack turns out to be Bahamas regulator seizing assets. How was Russia able to launch its biggest aerial attack on Ukraine? Japan's inflation soars to 40-year high. China circles El Salvador's economy as country edges towards crypto plunge. And Trump's terrifically stupid return to Twitter as two wealthy and self-involved men seek the attention they crave. Against this macroeconomic backdrop, I would like to welcome to the stage our strategic partner for the event, the founder of Dalma Capital, Zachary Cefaratti. Please welcome Zachary to the stage.
Morning and welcome to AIM Summit's 13th edition. Since 2015, AIM has been proud to welcome a profusion of global industry leaders and executives across the alternative investment arena, alongside world-renowned keynote speakers. As AIM Summit's strategic partner and on behalf of the entire Dalma Capital team, I'd like to extend a special thank you to Raha Maradi and the AIM Summit team for their extreme success in scaling AIM to become one of the leading global alternative investment conferences, not only in the region, but globally. We look forward to the continued success as the gold standard of alternative conferences throughout the world. This edition of AIM Summit convenes one of the most interesting and pivotal times in the recent economic and financial history. The decisions that you make in 2022 about your asset allocations, particularly in alternative investments, are more difficult than ever. Main central banks display an unambiguous determination to bring inflation under control, with the Fed carrying out 4 consecutive 75 basis point rate hikes and the ECB raising its key rates for the first time in 11 years to 2%. Asset valuations remain vulnerable as higher interest rates and weaker outlook for the economy have led financial assets to fall, and heightened volatility measures of equity prices relative to expected earnings have declined markedly. Spreads on peripheral bonds have risen steadily, and risk premiums in equity and corporate bond markets have drifted back towards the middle of their historical distributions. Low broad market liquidity is amplifying asset price volatility and potentially highlighting structural vulnerabilities in short-term funding markets. Moreover, forward-looking measures of interest rate volatility derived from option prices have increased, reflecting heightened uncertainty about the economic outlook. After an extended trend towards an incrementally lower rate environment, does this mark the end of an era and decreasing rates, low inflation, and loose monetary policy conditions? Given the high risk of inflation persistence, does Congress need to enact tighter fiscal policy measures to assist the Fed in limiting the economic damage from aggressive monetary tightening, and what will be the impact for the real economy? In the US and Europe, we find ourselves at the precipice of a drastic demographic transition. And in the absence of appropriate policy responses, this is expected to have adverse implications for potential growth, labor supply, and productivity. From a central banking perspective, population aging is widely seen as having exerted downward pressure on the natural rate of interest. However, this is a matter of debate. Now, with potential reversion to historical natural rates of interest, will the demographic transition cause a greater drag on economic growth and constrain monetary policy and fiscal policy to maintain price stability? Prior to the pandemic, the emerging energy transition served as one of the great global macro trends. However, the pandemic and its economic aftermath have caused drastic fluctuations in energy demand, oil price shocks, distributions in energy supply chains, and have hampered energy investments, while the Russia-Ukraine war has left the world with energy price hikes and energy security challenges. The long-term impact of these crises on low-carbon energy transition and the mitigation of climate change is still uncertain. However, given the underinvestment in recent years, global capital investment in energy is expected to do more than double by 2030, proving the energy transition as inflationary, at least in the short to medium term. Will the energy transition contribute to high inflation persistence? Will it eventually become deflationary? What is the impact that climate policy will have on the efficacy of fiscal and monetary policy, as well as the interactions with the financial system and prices? We're also seeing a political transition take form, with the rules governing the post-war world order being tested and the world's hegemonic structure being divided between the West and the East, as China and Russia resist the US-dominated world order. The US dollar financial system has been weaponized, and global capital markets have become divided. Since the turn of the century, the dollar's share of economic international reserves has declined, reflecting an active portfolio diversification by central bank reserve managers. However, the decline in the dollar's share has not been accompanied with an increase in the share of any of the other long-standing reserve currencies, such as the sterling, the yen, or the euro. Rather, the shift out of dollars has been in two directions: a quarter into the Chinese renminbi, and 3/4 into the currencies of smaller countries. Characterization of the evolution of the international reserve system in the last 20 years is thus a gradual movement away from the dollar. A recent yet still modest rise in the role of the renminbi and changes in market liquidity, relative returns, and reserve management enhancing the attraction of non-traditional reserve currencies. How will the international system evolve going forward? And could the deepening of financial markets and non-traditional reserves what will this place on the US position as a global hegemon? Will this cause potentially a loss or a weakening of the US dollar status as the world's reserve currency? As we gather here in Dubai, we note that the UAE has given us a unique vantage point. Having been largely politically and economically insulated, the country has managed the pandemic adeptly and has attracted a growing number of hedge funds and leading financial firms that seek to limit their exposure to economic instabilities in their home countries. I hope that some of the questions that I've shared today are questions that you'll leave this conference with better answers to than I can give. I'm, again, very grateful to all of you that have joined, to everyone who supported this conference in its 13th edition and in the 12 editions prior. It's an honor to be here, and we hope the conference will help you connect with the ideas, the people, and the markets that you need to help you succeed in the alternative investment landscape. Thank you.